Well, there were a few different issues. You take it from the borrower side, and yes, those that obviously need the money, there's definitely demand there. But it was more nuanced. There were unclear EBITDA coverage numbers that you had to meet that wasn't necessarily clear. A lot of borrowers had to take personal guarantees that they didn't want to take on. A lot of existing debt that businesses had wouldn't allow another form of debt to come in, even pari passu, and certainly not above in their terms of their relationship between the two. From a bank perspective, if the loan is so great, why would I want to give 95% to the government? And even if 5% goes bad, it's still 5% that goes bad. So maybe I'm less inclined to be giving out that loan because my lending standards have tightened anyway. So while on paper it may sound good, I think a bank would make this loan anyway, irrespective of the Fed's presence.
So, Steve, here's a question. I mean, if they wanted to revive this program at this point, could they? If not, then, I mean, is this where the whole point of what's going on Washington right now is to figure out a way to say, okay, well, then let's repurpose that as PPP or jobless, benefits or some other more direct form of assistance?
Yeah. Well, first, I need to say that Peter Bookvar's talents are wasted in analysis because he sounds exactly like the community bankers that I spent the last 3 days speaking with. He was right on the mark about the pari passu issues. Why is the bank pari passu with the losses of the federal government? Are the EBITDA considerations too strict? This is a program that did not do well because it was not designed to do well, in a sense. The government took very little risk with its own money. Congress gave the Treasury money, and the Treasury decided, it seemed early on, not to lose any of it, with the idea being that Mnuchin would say Congress didn't want me to lose that money. Well, okay. And then what happened is you made a series of loans that were essentially the way a bank would make those loans. I can give you an example. It takes 30 days to approve a commercial loan. That's about what time it took, plus the Fed approval time, to approve one of these loans. I'll ask you a question, Kelly, and I'm sure Peter has the same answer, which is, if I'm giving you a $5 million piece of a $100 million loan, are you going to spend any less time looking over that loan because you could lose $5 million and not $95 million? And I think the answer is no.
Yeah, it'd have to be pretty big for that not to make a difference. So, Peter, let me give you the last word here then. For those people who are saying, all right, then let's take a step back, maybe have a fresh slate come January, or if this is under debate in Congress at this very moment and we need something done by next week, what is the answer?
Well, for these businesses, the answer is really more equity, not more debt, for those that already have a lot of debt. Now, I know you can maybe restructure the PPP to sort of widen and liberalize the requirements to be able to get it, but also inviting us, and there's trillions of dollars of private equity money out there. Let's try to convince them to make some equity investments in these businesses that need capital, both small and medium sized.
Shepard Smith here. Thanks for watching CNBC on YouTube.